Thank you very much for joining us today at the Allan Gray Fund Provider. The CIO panel is definitely one of my favorite slots of the 2 days, and that's not just because I'm moderating it. It's definitely been an interesting time in the markets over the past couple of days, so it's giving us quite a lot to talk about. So before I start, and I've got kind of more questions as always than we have time to actually discuss, I want to quickly introduce our panelists, although they don't need a lot of introduction. But really it's an introduction and a thank you. So Gavin from Camissa, Sandile from M&G, and obviously Duncan from Allan Gray. Thank you for joining us. These events are only really good because of the participants, so we appreciate you partnering with us on it. So 2025 was a pretty interesting year. We started off actually, I think, quite cautious. And if you think of the reality, things looked like they actually got a little bit worse, you know, geopolitical tension, some interesting changes kind of from an economic perspective, but yet markets weren't really listening. So I was going to ask the team in the studio to pull up sort of some of the market moves, kind of to put the 2025 returns into context relative to sort of the 10-year averages. And then we kept updating this over the last couple of days. Just thought it would be useful to put in how it's done since the beginning of the year. Not that any of us are short-term focused. I just thought it would be an interesting backdrop for us to start our conversation today. And maybe, Duncan, when you look at that slide, which I hope that everyone now can see, when you think of some of the most interesting moves from last year, or perhaps the most unexpected moves, you know, what stands out to you?
I think what you mentioned earlier is quite interesting. No one even remembers Liberation Day now, where the Aussie went from 92,000 to 77,000, back to 92,000, all in a month. But I think obviously for South Africa, sort of the most important move has obviously been the precious metals. So a big move up in gold, but gold's been trending up for a long time, whereas platinum actually went vertical in a month or two, and we all know the price for silver. But I actually think last year the most important price move is one we can't see, and that's a valuation of the AI companies, right? If those valuations are true, and they may not be, and I tend to think they're overvalued, the world's going to change quite a bit over the next while, but you can't actually see it because it's not on your
In other words, you can see it in share prices, but you haven't really seen it in fundamental change.
Well, we can see the valuations of OpenAI, of Anthropic, of SpaceX, of all these companies, and baked in there is the world's going to change a lot, and they're going to take away a lot of revenue from other businesses or create whole new business streams. But it's not something you see because you don't focus on it every day on the screen.
Okay. Sandile, I'm going to just point out another, what almost looked like a reversal of a long trend that seemed to be unwinding last year. And if you look at some of the top performing categories, they were emerging markets, so either Africa or certainly SA. And that's been, you know, emerging markets have underperformed the US certainly, but more broader kind of world markets for well over a decade. Yeah. Is this the start of it turning? Or is it too soon to kind of write off the US?
Yeah, I think, you know, one of the really interesting things about retrospectives is interrogating where you were wrong. And so, you know, we have always, you know, said emerging markets are looking quite interesting at, you know, starting January 2025 valuations. South Africa is no different, both bonds and equities. And so the return that's been delivered has certainly been a massive surprise. And we often, you know, sort of want to be quite humble about what we think we know about the future and what we think we can say about the future. Certainly 62%, you know, plus in 1 year is pretty wild in dollar terms. But it's, you know, if you sort of take a step back and think about valuations, it's not a surprise. And we always, you know, we say things don't happen in a linear fashion. And so, you know, if your equities are going to give you, you know, 20% per annum for the next 10 years, that might arrive in 1 year, for example, like we saw in 2025. I think the real question is, looking forward, do we think that return, you know, has basically brought forward all of your future expected returns? We don't think so. So we still think there's a lot of value, specifically in emerging markets. And, you know, certainly from our perspective, you know, like Duncan's just said, those, you know, hyperscalers and frontier AI labs in the US who are private might very well deliver, you know, massively new revenue streams and grow the economy in quite a brisk fashion. But we don't know that, and so I think on a balance of probabilities, we would say emerging markets still look quite cheap. If you have another year of 60% versus 10% or 15% from developed market equities, you shouldn't be surprised.
Okay, great. So if they haven't, I'm just going to ask the team to drop the slides so that we get a better view of the gents on the panel. So Gavin, we were speaking last week when we were preparing for this, and I know that you build your portfolios from the bottom up, and it's all about a relative attractiveness across asset classes and individual securities. But at the same time, we are seeing big shifts in geopolitical risk locally and globally. So how do you factor those risks in when you're determining the intrinsic value of underlying businesses?
Yeah, I think that what one has to have is a bit of humility about what you can know about the future. And
a lot of humility, I think.
Yeah, and I think that I've seldom met anybody who could predict what's happened over the last 5 years. I mean, I think very few people, if any, have been able to predict. I think that you've got a lot of smart people in our industry trying to predict what's going to happen in the next month, next week, next 6 months. And I don't think it's that useful. I think, there's a lot of smart people doing it. There's a lot of rich data. I don't think you necessarily get it right. And I think that it's not really a useful exercise. So what we tend to do is trying to look forward a little bit further. So 3 years, 5 years, 10 years, what are the bigger geopolitical trends and how they might unfold, which clearly there's a lot less data on. It's a lot more ambiguous. It's a lot harder to do, but it's a lot less crowded space to be doing it. And I think as hard as it is, it's much more useful to do it. For example, think about what's going to happen in democracies of the world as the world gets more unequal. So the world is getting more and more unequal in terms of wealth and income. And with AI, if as Duncan said, if those valuations are to be believed, it's going to accelerate in an exponential fashion. And the labor-intensive jobs are going to disappear. And the rich who own these stocks and who own these businesses are going to get more wealthy. And when sitting in democracies, how does that unfold? So I think that one would be, I think you'd tend to lean in the direction of populism becoming more to the fore even than it is today. Which way does it go? Does it go left-wing populism, which is more redistributive, which isn't the case in the US now? Or does it go right-wing populism, which is tends to be anti-immigration, more towards the elites and has perhaps installs autocrats in democracies to some extent. So I think those sort of discussions and those sorts of thoughts about the longer term risks are what we try and concentrate on and try and think about. I think the shorter term events are unpredictable, and when they happen, they give you price opportunities that we take advantage of. In general, when there's lots of bad news, prices go down, and if we've got a positive long-term view on something, we'll be buying those things that go down. And temporary good news, like often happens in South Africa, we have good political news and all our consumer-facing stocks go up a lot, and those tend to be very good times to sell. So I think it's taking a long-term view is what we do in terms of thinking about these geopolitical macro risks.
Okay. Thanks. I'm going to push you on that a little bit later to ask for some specific examples when we talk about positioning. But maybe actually the team can pull up, there's an asset allocation slide that we've put together, which talks to the sort of three funds, Allan Gray, M&G and Camissa. And I thought it was a useful way to try and draw out differences in how we're thinking about kind of how we're positioned, given what we've seen and obviously where we think the returns are going forward. So Duncan, maybe I'll start with you. If we look at kind of the far left and we look to SA, the interesting thing about investing in SA is that it's a very concentrated index, but over the last 10 years, the areas of concentration have changed a lot. So, kind of how do you think about navigating around that, and where are the opportunities that are underpinning Allan Gray's kind of close to 40% exposure to SA?
I think thanks, Tamryn. I think first of all, just to say, we don't think about our portfolio like this at all, because that 42% includes a lot of dual listed shares, which have nothing to do with South Africa, right? So when we look through the Allan Gray Balance Fund, our foreign exposure is over 60. if you take the dual listed shares into account. And we would also compare individual assets to each other. So if you go back a year or two where BAT was yielding almost the same as a South African government bond in hard currency, we'd be comparing having an exposure in BAT versus a South African government bond. Just on the concentration of the index, I think it's super important, and we've seen that in the last few months. If you do client presentations, people know how big gold and platinum have become, but they haven't internalized it yet. You do like these client presentations, you say, do you know, if you have 30% in precious metals, 15% in NASPAS, that's 45% just in two places. One carries a lot of geopolitical risk, even though Tencent's a great company. Over the long term, gold and platinum are very poor businesses. And let's just say you add the banks. You're sitting at 60-something% of the index just in three sort of things. So it's something I've been very interested in. Investment committees, DFMs, multi-managers, they know it. But when you say it to them, like, they don't kind of get it. And it's kind of a frustrating position to be in, because we can produce good absolute returns on an equity-only portfolio, but have negative alpha, even though you're in the actual shares. So what we've done is, with the concentration, we've thought about it a lot. So as an example, I know the gentleman next to me might disagree. Like, we've limited our exposure always to NASPAS and process. If you ever met an EM manager who woke up when Russia invaded Ukraine and you couldn't trade those shares for a year and a bit, do you want 15% of your portfolio in effectively one share? And then with the precious metals, very similarly, we've kind of limited the position to sort of like 10, 11%, which I think is chunky. You won't find many global managers who have 10% in precious metals. And I do think, just as a matter of interest, there are a lot of managers who've never owned gold shares before, because now they're just big in the index. As you know, Allan Gray has had a good and a bad history with gold shares over time. I know what it's like when they go down. They go down fast, right? And it's very hard to predict. It's not the same as when, for example, Richemont was 20% of the index. You can make up some kind of thing. Well, we know it's Chinese demand for luxury, and we know what their margins were. Gavin could say, the gold price, he thinks it's worth 7,000. Sandile could say 1. I could say 4. You stick that in your model, the shares are worth, something very different. So we try to do the concentration by thinking about risk. And maybe just one thing to add, obviously, the offshore increase to 45% makes a big difference. Right? You can get a lot more diversification. Leave aside the argument whether it was more to be in South African shares like M&G were or offshore. There is the opportunity to take 45% offshore and have whole sectors that we don't have on the JSE.
So Sandile, do you disagree? I mean, one of the, and I appreciate that you guys don't look at your portfolios like this, either in absolute or in relative terms, but it's a way to draw out the differences, and it's probably how your clients might be seeing it. And one observation here is that your offshore exposure is lower than, Allan Gray or Camissa. So maybe you could walk us through that and tell Duncan if you do disagree or not. I'm not the stock guy, so I'm probably going to let him off the hook there. But I'll send a couple of my colleagues after him afterwards. But in all seriousness, I mean, we sort of think about constructing portfolios using 3 distinct levers. Partly because we think we have an edge in all 3, but also partly because it sort of makes sense to hold people accountable and to make sure the process is quite explainable. And the first is really to think about what is the long-term positioning of this portfolio through time. If things were at fair, where should we be? If we think assets are priced at fair, which, granted they really are, where should we be? And that serves as, our GPS coordinates of where we should be going if we want to meet, long-term capital objectives with some level of capital protection for our clients. And we call that the SAA. And we sort of construct that with a view, like Gavin, taking the long-term view, thinking about what is the underlying, return generation of these assets over the very long term. And this is like 20 plus years. And in that framing, we probably arrive at, an optimal offshore weight of between 30 and 35%. Okay.
The moment you go higher than that, a lot of what happens is you're getting whipped around by the rand. So, the currency has a massive impact on what your rand returns are going to be. And so there is a sweet spot, and we think it's between 30 and 35%. Of course, we can argue and quarrel about is that the right level or not. So I guess from a strategic sense, we're probably always going to be a little bit lower than some of our peers, partly because we do take into account the fact that a lot of our clients, pre-retirement savings, and so they have rand-based liabilities. And so that's massive in terms of determining what your SAA should look like. The second piece, which I think is a lot more interesting and certainly provides for a lot more quarrelsome debate, is on the tactical side. And so, currently, yes, we have, cheap assets in South Africa and we have cheap assets globally, and there is the opportunity for diversification, as sort of Duncan said. But South African assets are very cheap. Where else in the world are you going to get equities, without any building in any re-rating, giving you somewhere close to 8.5% real returns? It's on a forward-looking basis. It's it might be the hyperscalers, but I can't invest in those because they're all private. South African bonds, for example, are giving you over 5% real. And so those are compelling returns. And if you look at the valuations versus their own history, very rarely do you get afforded those opportunities. And so if we stood, in 2025 at the beginning of the year and said these equities are going to give you 9.5% return real over the next, 10 years plus, no one could have predicted all of that's going to happen in 1 year, 65% return or whatever it was. And so I think it's very important to be quite distinct about, strategically we think we should have, between 30 and 35%. Tactically, where should we be? We think most of the opportunities are sitting in SA. And so we will definitely have a tactical bent to be lower than our peers in that regard. But then it's also, what do you do with your allocations as well? And the third lever is really on the instrument or security selection. And there, once again, we have a pretty rigorous, well-defined, risk-defined process where we are looking to generate returns from taking security alpha. So what does that mean? It means I'll constrain my portfolio managers and say, I'd like your sector bets to be quite constrained, because the moment you go over 5% overweight or underweight a specific sector, you're taking unrewarded risk. I'd like my portfolio manager on asset allocation side to say, actually, you can't be more than 10% over underweight a specific region or a specific asset class, because the moment you do that, you're taking unrewarded risk. And so that's controlling that risk at a portfolio construction. It does a lot of the work for us. And then you still have ample opportunity within each asset class to pick the right instruments to outperform your benchmark.
Okay.
And so
Okay, that's great. I'm going to let Gavin kind of answer the next question, which I hope will be a follow-on from what you've said. So I agree with you. SA equities look cheap relative to history, relative to kind of offshore equivalents, but there's also kind of some local, political, other issues that might constrain some of the long-term earnings prospects. And I know a lot of the questions that came through from people before, today was, has it run ahead of itself? So Gavin, when you look at yours, it's interesting. It'd be interesting to hear your view, kind of, on the trade-off between equities and bonds, given the performance we've seen over the last year, and what are the areas that you're finding attractive?
I think that the first thing I'd say is that our asset allocation process is a little different to what I think's been a little bit more similar to Duncan. I think, first of all, we think of two main asset classes, which is equities and fixed income, debt instruments. The one's contractual, the other's the residual after costs and after you've paid your interest. And so our first decision is of the universes that we're exposed to, what are the biggest expected returns in equities, and can we, and we've historically delivered a lot of alpha. Can we deliver alpha? Are there alpha opportunities? And we set an allocation to equities. Then we take a look within equities between local and offshore. And then on the fixed income side, that's always the residual side, and we'll look again between local and offshore. And so I think that as a starting point on the second part, between local and offshore, it's almost an irrational thing for an investor to think that you wouldn't be running close to your maximum 45% through time.
Talk us through why.
Because there's so much more opportunity, there's so much more to diversify, there's so much ability to capture parts of the world that are not captured here in South Africa.
So you disagree
so
with
completely disagree,
the volatility
completely disagree,
introduced by the currency.
So I think that our equity market is well over 50%, and last I looked at it was around about 60% offshore earned. So the currency whiplashes our local equity market just as much as it whiplashes the globals. So I think that's I don't agree with that. So I think it's irrational to take less than close to 45% offshore between your fixed income and your equities. So at the moment, given the run in equities, we're a little bit lower in overall equities than my colleagues here. We're around about 67%.
So you've pulled back.
Pulled back materially. Yeah. 2 years ago, we were completely different. We were much more South Africa, much less global, and the rand was much weaker then. The rand has strengthened. The rand's added a lot to the local returns in dollar terms. And we've switched it around completely. We're now a lot less in local, a lot more in global equities, and a lot less in equities in total. And then given
slightly more in SA bonds then.
a little bit more in SA bonds, but within that, again, between 2 years ago and today, massive difference. 2 years ago, when interest rates were well over 13% at the very long end, we were very long in SA bonds. They're now, it's unbelievable how much they've re-rated. I think in our careers, we will never see a re-rating of SA bonds that goes 4.5% plus a drop in the long term. I do not think. I will take lots of. I'll take lots of bets on that. We won't see a 4.5% move in our yield curve down. And so I think a lot of that has been earned. So despite it looking like we've got a lot of bonds, which we have, it's much more short. So it's very much more in the 0 to 5 year region, and I think it's going to outperform cash. So cash and credit are looking expensive, and floating rates are going down. So I think in the more like 5 year region, so we're a lot less risk on, and a lot more global, a lot less local. I think I think just a final word on the South African stocks that look cheap. Those South African stocks are facing an economy with extremely low growth and very big structural problems that could cause that growth to derail. I think there's a lot of optimism baked into even those low valuations. And so I think I'd much rather have our clients sitting in offshore companies which have got very little to do with South Africa's problems.
Okay, I have to give you a chance to counter. I can see Duncan's also.
I'll let Duncan jump. I just want to say on the GDP, point, there are very few equities that have, high correlation with GDP growth.
True.
So the growth concern in SA is not something new and has not been, it was the same growth concern last year.
Okay. No, good point. Duncan, I could see you were about to say something, so I will let you, and then I will need to ask you, can you incorporate your view on SA bonds? Because Allan Gray's positioning in SA bonds is
so
low.
just if we look at shares, which two things I would say. One thing is people look at the overall index, but there are loads of South African shares, to Gavin's point. Like let's take Standard Bank, it's up 50% from the bottom. And there are tons, even Old Mutual is up 30%, right? There are lots of South African shares that are re-rated. It just doesn't look as good because you're looking at the index at 42, which is driven by precious metals and NASPAS. Second of all, it's more studying from university because often, theory doesn't help in the short term. But if you actually do the theoretical PE for South Africa and you take the growth and the cost of capital, because the real rates are still quite high, the actual theoretical PE for South African Inc. stocks about 8. If you believe theory, and obviously theory does well. On the South African bonds, listen, Gavin's done much better than us, right? We increased the duration quite a bit during Liberation Day, but we were a little bit sort of shorter duration, partly my fault. I think me and Talia were a bit more bearish. At one stage, if you're one of the larger asset managers, you see one or two of the auctions at one stage almost failed. Right, that's how close we were. And we'll leave aside Jafekra because it gives you a headache trying to figure out what exactly it means. But I think at the moment, I think my comment to the people was I'd rather eat my own cooking than buy the long bond at this level.
Okay.
And have you enjoyed your cooking?
That's what I just said. My cooking's terrible.
Okay, so I think we've mentioned it a few times, but I haven't really asked the question on kind of what your outlook for the gold price is kind of from today's point. And I say today, so it's kind of almost back to where it was kind of before Thursday, where it started dropping off and then recovering. But we have seen a significant rally, and there are lots of reasons why there's been sort of structural and cyclical tailwinds. But maybe Sandile, what's your outlook? You can't ignore it. So what's your outlook for gold and the gold miners?
If I say what I have an outlook, I'm going to get crucified.
You are, but that's
but look,
that's why we have these panels.
Exactly.
Something to whip you with next year when it's wrong.
Look, I'm not the sort of gold sector specialist, but from the very few conversations we've had on the actual spot price, I think saying something about the spot price, you're invariably going to be wrong. And so, what is the sort of marginal driver of the spot price over the last 2 or 3 years? If you sort of take a step back and think about when gold actually started running, it was, after Europeans and the Americans basically said to Russia, we are going to seize your dollar-based reserves. And so you had emerging market central banks going, hang on a sec, this doesn't look good. If these guys can do this to Russia, what can they do to us? And so you had a massive, tailwind of diversification of central bank, reserve managers looking for alternative ways of diversifying away from the dollar. Has that run its course? No one knows. Does that mean, if they stop buying, is the gold price going to collapse? No one knows. The consequence for gold miners is really, which is something that we and sort of share with my colleague on the right, gold miners have never been very good at, capital deployment, especially after a massive short-term run in the gold price. It seems as if things are slightly different this time around. You're not hearing about management looking to, go and acquire marginal gold mines because they want to increase volumes to take advantage of the run in the gold spot price. So it seems as if, you might be able to get away with getting some level of free cash flow. Certainly at current spot levels, they're looking quite cheap. But yeah, they do break in a lot of optimism. And so if the price falls again, another 30-40%, you will probably have to think about reevaluating that. But so far, it looks as if the earnings base is pretty solid.
Okay, I'm gonna move to Gavin, but before that, I'm gonna ask Duncan. How do you think about sorry, if we can just ask the team to pull up the top 10 shares, the SA shares across the funds, and how do you think about the sizing of AngloGold in the Allan Gray Balance Fund today, given the run? Yeah. And given the comments about translating increases in the gold price to earnings.
As I say, you get different kind of investors in the world. Like, I think I've held the gold ETF since 2006 without selling it, right? And I've sold a little bit every now and then because, when South African bonds sell off, it's really good. So the gold shares have often been a hedge. So I've always liked some allocation of my fund there because they give you this optionality, like in 2008 or 2015. But they can be very poor businesses for long periods of time. And so AngloGold's an interesting one because it was also it's got its own very good story. Like, we really rate the CEO of AngloGold very highly. He came from BHP, and when you met them, a very clear plan. So forget about where the gold price was. He was like, we're taking this portfolio, we're leaving South Africa, which cost them 5 billion rand in the end. I don't know if anyone knows that, to change list, to change domicile. And they've got a very good portfolio. He's thought about it very well. So there was also quite an idiosyncratic sort of thing. Obviously, at the moment, it's crazy because the costs are 1,600, 1,700, and you're selling something for 5,000. So the spot yields are going to look attractive. But as I said to you, you could choose any price you want. And that's the problem with gold. If you're someone like me who grew up at Allan Gray, with Jack Mitchell and reading sort of Richard Russell and Mark Farber and Jim Grant, you're always going, is this the time? Is this the time when the global debt collapses and gold goes to... That's the strange thing about it, right? And that's what makes it so difficult. But at spot, the gold prices, so we would think Gold Fields has made 2 bad capital allocation decisions recently. They overpaid in Australia and they overpaid in Canada, but guess what? It doesn't matter. They're going to make so much money with the gold price where it is. But what we have been doing is we've been reducing the position in precious metals, and we've been buying South African stocks. It's just the shares have moved up so much.
SA Inc. stocks?
Yes.
Okay.
The shares have moved up so much
that
it still stays that size of the portfolio.
So Gavin, if you look at kind of the top 10 shares in the Camissa fund, I can't see below that, but it does seem like there's more of a skew to platinum than gold. So maybe you can talk us through that.
Yeah, we have 0 gold shares in any of our portfolios.
Okay. So that wasn't just because I couldn't see the underlying hold. Okay.
No, I'm just filling you in.
Okay, good.
So I think that the possibility in a cyclical company like gold, where the commodity is set for you outside of the company, and even the people who've got large positions in their funds in these shares have no idea where the gold price is going to be. Whether it should be $5,000 an ounce today or $3,000 an ounce when Russia's buying and diversifying away from the dollar, or China is, who knows? Is it 5,000, 3,000? Is it 2,500? Definitely, it's probably 2,000 because it's just above their costs. No one has any idea where the level of the gold price should be, and I think you can have a call perhaps on whether the geopolitics will stay unstable and uncertainty will persist, and some of these central banks, you can look at how much U.S. treasuries they've got and how much they're selling to buy the golds. But eventually, they're going to have sold all their treasuries. So then what? You need the marginal buyers to keep buying. So I think that the gold price is completely unforecastable. The one thing that you can say is when there's momentum, the momentum often continues, and it often continues for a lot longer than you think. So that's the major reason. So we've had a large position in platinum shares. We had a very large position right at the bottom. We've sold an inordinate amount of platinum shares as they've gone up. I mean, it's a company like Northam has more than quadrupled off the bottom. We had an 8% position in our carve-out of equities at the bottom and owned over 5% of the company, and it's quadrupled. So if you do the maths, that could be a very, very large position in the portfolio if you've not sold an enormous amount. So we've sold an enormous amount of the precious metals, had no gold along the way, and continue to sell the platinum shares as they go higher. I think you can make a strong fundamental case, but I think the precious metal comments I made where there's momentum and the gold price is going up for momentum reasons is dragging the other precious metals up. There are some other factors, some industrial factors, and there's some ideas about resource nationalization and strategic stockpiles of metals that may feed into the PGM investment case rather than the gold investment case. But I think they're way in excess of their fundamentals, and we're in the realm of speculators driving those commodities, those precious metals higher. And there are many, many reasons why eventually that will end. From people who have a lot of gold wanting to eventually sell, like Italy's talking about, and to reduce their government debt, or for people with jewelry to go and pawn them and get a fortune. I've got a Kruger Rand that I'm just dying to sell, I just haven't had the time. So eventually the selling happens. High prices is the big cure for high prices in commodities. And as Duncan said, when the gold price turns, there is no floor for some of these gold shares. And I can't look my clients in the eye and say, I can have some of these in my portfolio where there is no floor.
Okay. Sandile, I've got two more questions on the local positioning. Thanks, Gavin. And then before I'm going to move to offshore, because I know we've got about 15 minutes left. You know, if you look through into the M&G fund, you guys have got a sort of a reasonably large combined weight to financials spread across a number of kind of, larger holdings like Standard, Absa, FirstRand. Maybe you can talk me through what's driving that.
I mean, very quickly, it's effectively a valuation call. And we've observed a lot of the self-help levers that we had expected to happen, actually happening a lot quicker. So in the case of Absa, cleaning up their portfolio, trying to rationalize some of those businesses and actually seeking higher growth markets across Africa. Standard Bank, is a name that we've liked on and off for over 5 years. Banks are preferred interest rate sensitive financials, if you will. Insurers, not so much. And why is that? We, much more complex businesses, high, that don't really have as much cash generation ability or the ability to pay you a pretty decent dividend that's been growing quite well over the last 20 years in the case of Standard Bank. And so it's really just coming down to the valuations and pretty solid capital base.
Okay, great. And then Duncan, finally, if we look at Allan Gray's positioning, notwithstanding the fact that you talked about buying more of the SA's Inc. shares or increasing the exposure more recently, we've got a higher exposure to something like AB InBev and BAT. So maybe you talk through kind of the underlying thesis for those.
Okay, so I think just in a spirit of disclosure, we've sold almost 40% of our British American tobacco position. It was our number one alpha share last year, so we recycled that. It's still, it's trading almost on a double-digit PE now, but if you look at Philip Morris over 20, if people do start to believe in the NGP, you can go halfway and people compare it to European staples. So I like it as something that you don't have to bet on South Africa, you don't have to bet on bonds, you don't have to bet on tech, you don't have to bet on China. It's something that brings something different to the portfolio, which I think is important in a balanced fund. So AB InBev, it's my biggest share in my slice. It's been a strange share. It's gone from $44 to $72 yesterday, but over 2 years it's flat, right? And so what we really like about it, again, is it's not SA Inc., it's not tech. You can't AI beer, I hope. It'll take away a lot of pleasure in life. And what I like about it is they've thrown away the 3G way. So the 3G way are obviously the Brazilians who built AB InBev from zero. Massive acquisitions. People forget they were going to bid for Coca-Cola after SAB. And they hugely overbid for SAB Miller, got stuck with $100 billion of debt, not growing. And what's going on in the new management, they've kind of let them go. So guys, we're going to grow organic volumes, and they've got a lot of tailwinds for them. headwinds for the last almost decade have been emerging market currencies. Those have turned the other way around, so that the input commodities have gone. And other than Coca-Cola, if you actually look at the beer business without the acquisitions they made, I think it's probably the second best run consumer business in the world. Now, will that come through? Because the bears would say, guys, the earnings were $5 a few years ago. They're still below 4, right? So they're not growing their dollar earnings. We think that's changed. So I do think in these funds, I do think about it a lot, where you want things that can produce different returns in different sort of things. And I think if I look how commodity-based we are, if we look what things could happen in South Africa, and particularly, obviously for us, we can see what Orbis are doing in the portfolio. So obviously Gav runs his own offshore. We can see what Orbis are on. How Orbis positioned. They don't have any consumer staples, right, other than BAT.
Yeah.
So it's nice for us to just have something where Orbis are quite value, sort of cyclical, semiconductor, emerging markets, career in the portfolio, and AB InBev brings something quite different. So let's see.
Okay, well, I think that's a good segue into offshore. And Sandile, when I looked at a lot of the questions that came through, I scanned down, and all I could see was Trump in about every third question. And I was reading an article the other day where Trump was quoted as saying the only thing that would stop him is his own morality. So I'm not going to go into that specific question, but if you were chatting to an advisor or client today, what advice would you have for them in terms of how they factor this risk and all this constant news flow and noise into making long-term decisions for clients?
Yeah, it's hard. I think,
well, that's why you guys are in the seats you are. It's not an easy job.
I mean, we one of the really interesting things that we do to new graduates and sort of new analysts is really get them to contend with, if you were making this call, what would you do? And often, you find the reason markets tend to be irrational at certain points in time is because the emotional, content of people's beliefs about what's going to happen is quite high. And so, the one thing we try to be quite disciplined about is to really stick to the facts. Yes, I might have a dislike for certain politicians. Yes, I might, be quite bummed about living in South Africa and low growth trap. But what does that mean for my portfolio? Well, if I do have assets that are looking quite cheap, they're often, accompanied by very bad news. And so, ours is to assess whether we think the margin of safety and the price accurately reflects the fundamentals. And build in, sufficient safety if we're wrong. And so going back to the case of, all the noise around Trump and tariffs and, the Don Rowe doctrine, as he calls it, if you just sort of close your eyes and say, okay, what have bonds done over the last year? US Treasuries have done nothing. Okay, so, you started the year with US Treasuries at over 4% nominal. In the 10-year and a bit high in 30 years, and you've pretty much clipped your coupon. Yeah, there's been some volatility. It's been uncomfortable in points, but you've had a pretty decent nominal return. Of course, our biggest gripe with last year was credit started the year quite expensive and ended the year even more expensive. And so the valuation on the credit side is even more stressed. We even hate it a lot more than we did last year. But on the nominal bond side, there are opportunities for you to actually say, yes, there are risks. Yes, things have deteriorated on the margin, but I'm being offered a pretty compelling yield to buy this asset. And the reason I'm sort of mentioning bonds,
and you've got to believe in a strong dollar under that scenario.
I'm not sure about that, but I don't know if you follow the meme around The Economist magazine. Every time they have something on their cover, it's either the top or the bottom.
Oh yes, no, true.
Okay, so they called the dollar top almost to the month, and it has repriced. I mean, the dollar's about 15%.
Normally they're a country indicator, though.
Yeah.
Yeah.
So the headline was the mighty dollar, and it's almost.
Right. Okay, they were calling that.
And so I don't know about all of that stuff. All I'm saying is, the valuations of bonds are looking quite attractive. Yes, fiscal metrics and fiscal dynamics in the US have deteriorated. Yes, inflation is a concern. But from this valuation point, and it's quite
Okay.
a subtle point about bonds that people don't understand, if you buy a bond at a specific yield to maturity and you hold it for a sufficiently long period of time, it offsets any capital appreciation or depreciation is pretty much offset by what you can reinvest that capital
Okay.
appreciation or depreciation at. And so 4% is 4%, 4%. Do I think 4% is cheap? It's probably fair. And it does some pretty decent things for us in the portfolio. When things like equities are selling off,
Yeah.
people tend to run to
Yeah.
developed market government bonds. On the equity side, yeah, I mean, I pretty much said
Okay.
all I wanted to.
So Gavin, you were talking earlier about, it'd be crazy not to run close to 45%. So with all those opportunities for diversification, where do you think is the standout area of opportunity?
Yeah, so I think that we are very underweight the US. I think that the US is exposed to a lot of the currency, the dollar, which has depreciated, so it's perhaps looking a little bit more fair. But valuations in the US are, in many cases, justifiably so, but on the rich side. They're incredible businesses. It's an incredible economy. But I think that taking that longer term view I talked about earlier and the geopolitics about the US, I think the US is continuously taking active steps to decrease its competitiveness in the world and the strength of its economy. From tariffs to attacking universities to being anti-immigration. I think these are all very negative for the economy. So I think that an expensive US in the context of a perhaps decelerating economy in the longer term, and I'm not talking about cyclically, and rich valuations, we've got a lot less in the US. We've got a lot more in Europe and Japan, and to an extent China. And in Europe, it's mostly multinationals that take their economic activities right around the world. But because they're invested in, or they're listed in Europe, their ratings and their valuations tend to be a lot lower. And there are some fantastic world-class businesses that one can invest in, and we've tried to pick a number of those. And then in Japan, I think Japanese mid-caps are very, very hard to understand, very hard to get your teeth into, very hard to translate anything that comes out of them into English, and very inexpensive, and sometimes are real gems. So we're doing a lot of work on Japanese mid-caps, and many of them occupy parts of our portfolio.
Yeah.
So that's a mix. So I think seeing quite a lot of excitement in non-US equities. And then I think we have been increasing US bonds. It's very small, but increasing those. I think 4.8% on the very long end of the US curve looks attractive to us, given that there's a lot of negativity about the dollar already baked in and the US fiscal position.
Okay, Duncan, so if I move to you, maybe you could round that conversation off with, kind of how the offshore part of the portfolio is perhaps differentiated relative to peers. And then I've waited almost 40 minutes to come back to the AI question. I feel we can't have a panel and not talk about AI, but we know how much the hyperscalers are spending. To put that to one side, it does seem like the market's actually focusing on who might win and who might lose. How do you think about the portfolio positioning given this big unknown theme?
Yes, I think what Orbis have done very well is look for the industries that can benefit without being the obvious one. So the only real big company they've owned is Google, and Ben did a fantastic thing. He bought it just before those results when Gemini came in. So that's what they've been looking for is like, let's say you have to have power for the data centers now, right? There are listed natural gas companies in the US that are specific in that region because you can't get it. The grid is to, what do you need to build the grid? So Alex done very well on picking those type of businesses that benefit from the rollout of the electricity, of those type of things. I think the second thing that's going to be super interesting now, let's take an example, banks. If you're very bullish now, you might say all banks are worth zero.
Yeah.
Why? But as Gavin mentioned earlier, a lot of these businesses that are very process intensive and people intensive, I think they could get a lot more efficient. And I think that's the next thing that's coming. Rather than people looking at Meta or Alphabet and those type of businesses, I think people are going to start looking which businesses can actually benefit, because it's super interesting at the moment. You'll see one survey of all CFOs in America that go, we don't even use AI. It hasn't helped anything. And then you read another survey which is, we're not going to hire anyone for the next 2 years. So it's really hard to get your head around, but I do think it's going to move more towards that thing where who can actually benefit from AI. I mean, in 5 years, it might just be an AI-generated panel here. It might not be us.
Certainly I'll be replaced. I mean, I don't know about you guys. Or actually, we can make a call on that. Okay, so I've got about 30 seconds left, but I am going to run over, so I'm just warning Alicia because I'm about to hand over to her. I'd like to end off with asking each of you, just to give me in kind of one sentence, what you think the role your fund plays in an advisor or client's portfolio. So, Gavin, maybe I'll start with you.
Yeah, I think that we are very differently positioned to where I see the bulk of assets, especially on the retail side, sit. In terms of stock selection, we're very different. We're more medium-sized, so we can have mid-caps that are very large in our portfolios. We take quite bold positions in asset allocation and fixed income. We're very much absolute-oriented rather than relative. So I think we offer a very different performance signature, a very different correlation to the rest of the funds out there. So I think we can be a great addition to the mix within an advisor's portfolio.
Okay, great. Thanks. That was more than one sentence, but I'll let you get away with it. Sandile, you next?
Yeah, I think we, the track record speaks for itself. We'll do your asset allocation quite well. We'll do your stock selection or bond selection quite well. And we will generate alpha from taking tactical asset allocation decisions across the cycle.
Okay, great. Thank you. Duncan?
I think the one thing where we add a little bit difference is we do bottom-up asset allocation, as I mentioned earlier. We're not sort of the specialist we bonds acting. We're comparing equities to specific bonds, comparing regions to other regions. And when you put it all together, hopefully it produces something different. And I think you're going to see that over the next couple of years with the 45% offshore, the dispersion between managers' returns, which you've seen, is just going to increase. And that's something for advisors to think about, because in the short term, you can have big divergence.
Yeah.
Someone who had 15% gold, someone had 0.
Okay. All right, that's great. Thank you very much. Thank you all of you for joining us and everyone for listening.